Good morning. This is Larry McMillan with the stock market update on Monday, April 22nd. So the market fell again last week, and we're now in a more bearish position. We fell below that support at 50.50, and that really changed things. There's some pretty heavy selling came in right after that, and that now represents resistance. So we're rolling our positions to a core bearish position. I mean, we've had a few sell signals the last couple of weeks. We have a couple more now. And, not necessarily saying this is the start of a bear market. I don't think anybody really knows for sure. But at least it's a correction of more than just a minor sort. So the S&P chart has support at roughly 49.50, and then 4,800 is the major support. If we fall below there, that would be into a bear market category. On the upside, there's various resistance areas. The first one is at 51.50. So the equity-only put-call ratios have maintained their bearish signals. They gave sell signals a couple of weeks ago, and they're flying higher now. So that's strong sell signals for the stock market. The S&P chart itself has actually fallen below its modified Bollinger Band, the -4 sigma band, and could be, therefore setting up an oversold buy signal, but that might take some time, so we don't have one of those yet. The breadth of the market has been terrible. It's resulted in both breadth oscillators being on sell signals, and they still are. There's one sort of bright spot, and that is the fact that we follow two oscillators, and they've widened apart. The New York Stock Exchange breadth has not been as bad as the average overall stock breadth. And when that happens, that is an oversold condition, and it will result in a very short-lived but sometimes strong buy signal when it's corrected. That could correct this week sometime. New highs versus new lows. New lows have finally taken the lead and the over new highs. So that indicator, which was bullish from basically last November till last week, is now in neutral status. It's not on a sell signal, it's just in neutral status right now. VIX is presenting us with, diverging signals. The first is a sell signal from the trend of VIX. The VIX itself has crossed above its 200-day moving average, so that puts it in a bearish trend, which will last until VIX closes back below its 200-day moving average. That 200-day moving average is just below 15. VIX is running around 17, 18 now, so that could last for some time. Meanwhile, a positive signal is just occurring from VIX. It'll probably be confirmed today, although we'll have to wait until the close to verify that. But VIX spiked up to 21.36 on Thursday night when the Israelis sent missiles flying towards Iran, and then it backed off. And so if it closes below 18.36, that's a buy signal, short-term buy signal, which could last up to a month or so. Those are, we have a long and profitable track record with those. The term structure of volatility derivatives has remained basically positive, so that's a positive sign for the market there as well. But overall, we are maintaining a core bearish position now. We roll long puts down as they become deeply in the money, and we will trade these various signals around that as they occur, buy signals or sell signals, whichever they may be. I invite you to visit our website. Take a look at the pricing on some of our daily newsletters where we keep up to date on these things in a more timely manner. Meanwhile, have a great week trading.